Welcome back to The Money Path. I'm Janet Alvarez, your host. We have an exciting episode for you today. We'll be speaking later on in the show with Rhys Williams, Chief Portfolio Strategist at Wayve Capital Management, about the latest in the market, the iPhone 16, why AI may not yet be contributing to Apple's success, and more. Joining us now, though, is a fabulous guest, Nancy Tengler, and she's here to talk about her new book. Nancy, how are you today?
Janet, I'm great. Thanks so much for having me.
So, Nancy, the title of your book is The Woman's Guide to Successful Investing. Tell us why you thought it was necessary to write this book.
Well, it's interesting. When I left the industry for a bit, and I met a lot of very smart women, MBAs, PhDs, who knew absolutely nothing about the management of their family wealth. And the average age of a widow in the United States, Janet, is 59. The average age of the first divorce for a woman in the United States is 30. And so it's incumbent on us to engage in this conversation. We've tended in the past to excuse ourselves from the conversation or be excused from the conversation. And so it's important for women to step up, to pay attention. And the research shows that women actually make better investors than men.
So, let's talk about some of that research because I personally find it fascinating. I've read a lot of it over the course of my career as well. Let's talk about the degree of risk aversion or risk taking that women are willing to take in comparison to men. What does the data show us?
Yeah, so Jen, I have 12 intelligent investing rules in the book, and the first one is that the biggest risk to a woman's portfolio is that we frequently do not take enough risk. So if you look at the data, left to our own devices, we hold more cash, we tend to be less competitive. But in a head-to-head series of studies where women's portfolios were compared to men's, they actually outperformed by over 1%. And if it was women against single men, they outperformed by over 3%. And I think the reason for that is simply women tend to do more research. We tend to be investors as opposed to traders. And over the long term, that produces better results.
So, we tend to trade less often, essentially, hold for a longer time horizon, and just follow the traditional wisdom to investing. That's fascinating. Nancy, I wanted to talk about this great wealth transfer that's occurring in society. And there's been so much written about the fact that because women are outliving men, they are through divorce or through widowhood, as you've mentioned, starting to become the purse holders, the purse string holders, really, in a lot of households. They're the ones who are making the decisions. They're the ones who end up amassing a great deal of wealth. Does this generational wealth transfer in any way impact the way women should educate themselves about investing?
Absolutely. Yeah. So if you look, there was a Boston Consulting Group study that was done in 2020, and they projected that by 2023, women would control $93 trillion of wealth globally, growing at 5 trillion. If you take that and set it aside and look at a separate study by UBS, they are showing that baby boomer, my generation of women, are engaging in the investment process more than millennial women. So it's a problem if the wealth is transferring that quickly and women are not sort of engaged in the process. 2/3 of women fire their advisor after the money spouse dies, and so they don't have a good relationship with them typically because they weren't engaged. So it's so important. And it's prudent just to be involved and engaged. And as I said, women, have been the shoppers, the decision makers on many products in the home, if not all. And so they do the research, and that is the same kind of research that is helpful in building an investment portfolio.
What advice do you give women if I suddenly find myself in a situation where I have inherited wealth or have been through a divorce or another situation where I'm suddenly in charge of more money? What is the best advice you can give a woman in that situation?
So if they have an advisor, Janet, then they need to have a conversation with the advisor that's super transparent. They are entitled to know exactly how their money's being managed at all times. I see every day the malpractice in our industry where people, not just women, but men and women, are not informed of what's going on in their portfolios. And this is particularly important during bear market periods, as you might imagine. Second, I tell them to read my book. to get Barron's and read Barron's once a week, because those journalists think like portfolio managers. In my view, they measure their results. And if they don't want to manage the money themselves, I have a glossary in the back of the book that gives them the language so that they can have a conversation, an intelligent conversation with their advisor. And I've had women come up to me from all over the country and say that improved their relationship with their advisor. I mean, the goal is not to have them leave their advisor. It's to have them leverage and benefit from an advisor's advice instead of being in the dark.
Nancy, you've been in this industry for a minute, and I have been working in financial education for a long time as well. And the project, the promise of helping women learn more about investing and become more empowered investors has been one that's been a long time building and a long time growing. Where are we today in terms of bringing that promise to fruition?
Unfortunately, I don't think we're very far. I'm on a board of the Economic Council of Arizona, Economic Council of Education for in Arizona, and there's a national group as well. And so starting that in grade school, which is what they do with the stock market game, and teaching about the fundamentals of investing is important. And I've spoken in a lot of Title I schools because I came from effectively a Title I family. Father left, mother worked 2 jobs. We were savers and barely that. We were not investors. But the only way to generate wealth is to save to invest. So I think we have to be more diligent. We're starting a foundation called Women of Wealth that's going to provide free education to women. We're just waiting on our approval. That's why we launched our ETF TGLR, because it's a pretty transparent, actively managed workhorse of a strategy. And so I think it's important to just keep the issue in front of women nonstop and really encourage them to engage and not feel shy about asking questions.
Nancy, you mentioned 12 rules of thumb in your book that you believe might help female investors. Tell us what you believe the most important one are.
I really do think it's the one I cited first, and that's why it is the first rule, which is women need to take more risk. And the biggest risk to portfolios is not taking enough. I learned that when I was 25. We had a client who had $40 million, and she was widowed. And she kept asking my colleagues, why am I in bonds? I don't need income. She wanted to grow that wealth for perpetuity. If I went back and looked at 3 IPOs, stocks that the performance since their IPO, sorry, that was vague. Amazon IPO'd in 1997. That means that's when it first started trading as a stock. It's up 235,000% since 1997. Microsoft IPO'd in 1986. It's up 683,000%. And Walmart, which IPO'd in 72, much longer period of time, is up 630,000%. So there is a lot to be said for buying great companies that you can own for a lifetime, holding on, and then just taking the risk, adding to them in down markets if you have the courage, but just not selling out of them in bear markets. And that's, I think if we can communicate that to every investor, but in particular women, we'll be in a much better place in 10, 15, 20 years.
Nancy, what is the greatest source of trepidation or fear or confusion you might hear from female investors when they approach the concept of investing for the first time?
Yeah, so Janet, I hear 2 things. First, from an age standpoint, I hear I'm too old. So I cite this example of a real life woman named Stephanie Muka, who didn't start investing in earnest until she was on a retirement income and died with $5 million. Another thing I hear is that it's like gambling. I don't get it. It's a sport. And so that's where the challenge is to say, and that's why I have so many case studies in the book about people and about stocks and what I experienced in my own portfolio to give courage and confidence. Because once women start investing, they get it pretty quickly, and then there's no turning back. But it's that first step into it's gambling. And I think we do that disservice to ourselves in this industry, particularly in the financial news where we talk about trades we made, day to day. Investing is about investing for 3 to 5 to 10 year time horizon.
How do we start speaking with our daughters now about money and investing? Because I hear so often stories of dads sitting down with their sons, teaching them how to pick stocks, how to read stock charts. How do we speak with our daughters the same?
Yeah, so I have a son and a daughter, and we're all in agreement that she should take over the management of the assets when I go somewhere far away. And so I think part of it is we did it at the dinner table and we gave equal time. We asked them what products they liked, what they were interested in. And then when we were shopping and just doing routine activities, they will tell you I was talking about it all the time, sometimes to their embarrassment when I was talking with the clerk at the store that I own the stock in. But it's important just to work it into the daily discussion. We do it with our clients' children. We have them pick stocks, have them write up a little report. It's like a version of the stock market game. And then we track their performance with them. And I think if we do that, and teach them to save to invest, not just to save to spend. And listen, I spend a lot of money. I'm not advocating a Spartan lifestyle, but you won't get there if you don't save to invest. And so that's the message, and it's got to be, infiltrated in every part of their lives.
It's the most valuable insight you derived from writing the book. What did you learn personally as an expert yourself when you went
Uh,
writing the book?
I learned a lot from the people I've encountered over the decades. I had one client who fled Baghdad, lost his whole fortune, and then rebuilt it in the United States. And I would call him. He asked me to call him once a month. I don't even know why he gave me the money. I was a child when he hired me, but he asked me to call him once a month, tell him how I was doing. So I would always start out and say, "Mr. Z, I've outperformed the benchmark, blah blah blah," and then he'd say, "I just want to know how much money I have." And that was a valuable lesson for me, because in our business, we do get very competitive with benchmarks. And there's a reason for that. Of course, clients are paying us, but really most people just want to grow their assets for a future goal. And there's multiple goals. I talk about mental accounting. You might have a goal for education for your kids versus retirement. They have different implications for what kind of stocks you own. But generally, people just want to increase their wealth. And they feel like they're too late, or they don't have enough money to save. And so those are the things I talk through and give examples, because that hurdle is big in everyone's mind.
It's the last piece of wisdom, the most important piece of advice you would like women to take from your book.
Just do it. Get an account open. You can trade fractional shares now. You can open a brokerage account with $0, contribute $25 a month, 15, 100. There were many years where I didn't invest because I was busy buying sporting equipment. And then it was like, well, I only have a couple $100 left over. And so I would spend it. Just save to invest and put it into stocks that you know and like, and then just stay with it. And remember the examples I gave you with those companies that have IPO'd.
Just
And their performance.
That's a brilliant way to think about it. It's simple, direct, and if people would just take that first step, if women especially would take that first step, I think the next steps come so much more easily. Nancy, thank you so much for joining us. Where do we follow you? Where do we learn more about the book?
Well, the book's on Amazon. I'm on Twitter. I don't do the other social media because I find it's noon before I get off. And so I'm on Twitter at @Tengler. And then we have a website, www.laffertengler.com. And that's where you can look at our ETF. You can buy a copy of the book, or you can just read the free commentary that we put up on our website.
Nancy, thank you so much again for joining us.
Thanks, Janet.
And it's absolutely a perennial favorite topic. The topic of women and investing and getting women more involved in investing is one that's near and dear to my heart. But so is the stock market overall and stock market performance. So coming up after the break, after this wonderful conversation with Nancy, we're going to be speaking with Rhys Williams. He is Chief Portfolio Strategist at Wayve Capital Management here in Philly, where I'm based. And we're going to be talking about Apple, the iPhone 16. We'll be talking about the market's rebound this week and much, much more. So stay tuned. Arnie Path, Janet Alvarez. We'll continue after this break.
Girl, you know it's been way too long. I got to get back in my zone. Hey. 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 All right. Come on. Come on. 3, 2,
And welcome back to the Money Cap. I'm your host, Janet Alvarez, welcoming you to the second half of our show, where we're going to be joined by Rhys Williams, Chief Portfolio Strategist at Wayve Capital Management here in my very own hometown of Philadelphia. Rhys, how are you today?
I'm doing great, thank you. A lot better than Friday, frankly.
No kidding. So we've closed up 500 points today. What was behind this rebound?
Well, obviously, last week was horrendous. I think it was just very oversold. And I think it was more, shall I say, more sentiment than actual fundamentals that caused last weekend's demise. And so I think really people thought about it over the weekend. And as you can see, we kind of opened flat and then kind of built momentum throughout the day.
Do you think that momentum will continue? Do you think are we still in an oversold scenario?
Well, we're definitely still in an oversold scenario. And I do think that clearly the labor market reports were disappointing. And I think especially the revisions over the last, 5-6 months were very disappointing. So I think it did put has the Fed waited too long on the table? And the fact is that we could have some sort of, mild recession. It seems more likely. So I think that's what the market's responding to. Now, unfortunately, what they did was they kind of sold the secular growth winners the hardest. And so that's why you've had this big rotation out of, tech into something else, so to speak. But I do think that actually, if we're right and we do have a mild slowdown, that the secular growth winners are the ones that are going to be the most the outperformers in your portfolio, because they have something to do with a secular growth story as opposed to an overall economic story.
So let's talk about the secular growth story, because we're seeing so much weakness across different asset classes right now. We're seeing a weak US dollar, oil down quite a bit as well, Bitcoin taking a little bit of losses in recent days. It's equities alone that seem to be on a rebound. Is there something happening in the equity market? Is it just rotation out of the Magnificent Seven into small caps? Is it just simple rotation right now that's driving the sentiment?
Well, I think for the last month it was rotation. It was out of Mag 7 into and tech, into consumer staples, into some REITs actually did pretty well. Some things that are going to be more beneficial in a lower interest rate environment did well. However, like I said, I think this is more temporary. And when you think about it, the reason why the Magnificent Seven are the Magnificent Seven is they've been able to grow revenue growth even at this amazing valuation levels, amazing sizes. They can still grow at 15 to 20% per year top line. The consumer staple companies, the leading consumer staple companies, if they grow mid-single digits, that's heroic on the top line. So therefore, I think the reason why these companies have grown to such levels is because they've been able to sustain well above average revenue growth. And I think even in a recession, the Mag 7 type companies will grow faster than the overall market.
Rhys, who are the next set of winners? In a declining interest rate environment, are we looking at the banking sector? Are we looking at home builders? Who are the next set of winners likely to benefit from this regime?
Well, we like home builders, especially because they've actually executed pretty well, even in a very difficult interest rate environment. And the reason is everybody has a low cost mortgage. And so there's no houses for resale. Not everybody, but you had 18 years of very, I would say almost artificially low interest rates. And so therefore, everybody's sort of stuck in their current home. There's no turnover. So if you want to buy a home, and lots of people do, you have to buy a new home because that's what's available. So I think that's been a godsend for these publicly traded home builders. And clearly with interest rates coming down, they're going to get a further boost. Yes, there'll be a little bit more competition because some secondary homes will be back out on the market. But I still think that the public home builders are going to be in a sweet spot and just have more buyers that can be able to buy their properties.
Today, of course, Apple announcing its iPhone 16 along with new lower priced AirPods, and announcing that a lot of the AI features of the iPhone 16 will start getting tested in beta fashion next month. That was a little disappointing to some investors. Apple stock down this afternoon. Were you personally disappointed by that? Do you think they're a little bit too slow in the rollout of the AI features?
Well, they are about 6 months behind Samsung, for sure. But Apple's always been sort of a fast follower, and my guess is their installed base is not going anywhere. And obviously the internet, or is this the AI 1.0 phone here, will be probably not nearly as good as the one that comes out 6 months from now or a year from now as well. So I do think Apple has that ability to keep its consumers, and my guess is they're going to get there. So I wouldn't read too much into one day's action in the stock price. Typically, Apple sells off after announcements. That's always been the case. And obviously, they've had a lot of really great announcements over the last 20 years.
Let's talk about the secular growth story for Apple, though, because we're seeing continued weakness out of China, which is a large part of their install base, of course. And even domestically, I think there's a little bit of a waning interest in Apple. Where does Apple go from here? Is it really doubling down on the AI story, or is it the hardware itself that'll be evolved?
Well, I think it's the AI story, which will help their iPhone sales. I mean, I definitely think if people want to use the iPhone, they're going to need more memory. They're going to need, I mean, all AI is a real power hog. And so if you're going to get the benefits of AI, you're going to need to upgrade your phone. And currently, basically the latest generation can take advantage of the AI features. And so therefore, there's 90% of their installed base will need to upgrade over the next 2-3 years. So I do think this will be a huge upgrade cycle for Apple. And so I'm not particularly worried about today's price action.
So we're not a political show, but we do cover economic policy and economic policy proposals. And tomorrow night is the big debate between Vice President Kamala Harris and former President Trump, as they both seek to win the presidency in just a couple of months. It's amazing how quickly time is flying. But we're hearing a lot of economic proposals from both parties, frankly. I'm curious to hear what you're going to be listening for tomorrow night. Are you looking for details or information on tariffs, immigration policy, on tax proposals? What are you keeping your ears open for?
Well, I do think that from a market point of view, that Kamala Harris did walk back some of the capital gains proposals that Biden had put out there. And I do think that was sort of a scary number for the markets and for investors in general. So I think the fact that she walked back that down to 25%, sort of takes the worst case scenario off the table for investors. But my guess is the debate it will probably be considered a draw. Mike, unless somebody does completely horribly, typically everybody hears what they want to hear. And the people that were favorable towards Trump will walk away thinking he won. And the people that were favorable towards Harris will walk away thinking that she won. And my guess is there won't be too much substance new on this debate. That's my guess.
One of the interesting things that one of the most interesting things I think of the last few years in regards to economic policy is that Democrats and Republicans seem to be in some degree of agreement about their approach to China. Both Democrats and Republicans. I mean, I would not have imagined this 10 or 15 years ago, but now we're at this place where both Democrats and Republicans sort of are something of an agreement regarding how to manage China. I guess the question is, what does that mean for the world economy? What does a more defensive U.S. posture toward China mean for the global economy, for our own economic prospects? Of course, we're not as dependent on China as a lot of other parts of the world, but a slowing China and a China that has to be more defensive, really got to have an impact globally.
Well, I do think it's going to put the pressure on AI to be a productivity enhancer, because clearly one of the big beneficiaries for the whole world was the Soviet Union breaking up and Eastern Europe becoming part of the world economy and Russia becoming part of the world economy. And then, of course, China going from basically an agrarian economy in the 1970s to the second largest economy in the world. So that was a virtuous world and a virtuous circle. And now we're getting into a bit of the other side of that, which is reshoring, which is not a positive probably for margins and for growth worldwide. So I do think it puts the even more pressure on technology to be the solution here. Is it a positive or negative? It's a negative, and I don't see what's going to change the dynamic, because ever since Trump won in 2016 and won by winning Pennsylvania and Michigan and Wisconsin, ever since that happened, both parties have decided that China is the enemy and that trade is the enemy. And obviously, in general, China and trade have been very positive for the American growth story over the last 30 years.
I want to get your opinion, because we're both here in Pennsylvania, and that big U.S. steel saga that's ongoing. Nippon Steel interested in buying US steel, but there are some natural protectionist tendencies, of course, right? Because steel seems like such a essential industry for a nation to be able to control on its own. But US Steel is saying, hey, if we don't take this offer, we don't know where we're going to get the capitalization that we need. Wondering what your take on this story is.
Yeah, it sounds like it's gonna get rejected, right? So it doesn't really matter what my take is. I think it sounds like it's not gonna happen. And my guess is US Steel has bumped along for many, many years and will continue to bump along. On the other hand, potentially, what needs to happen is the steel workers need to weigh in support of the deal if they decide that's the case, that it's better to be part of Nippon Steel than to be part of US Steel. So I really think in the end of the day, Biden will listen to the steel workers. And if the steel workers want this deal, it has a chance of being resurrected in the final hour. But like I said, it does sound like in the near term, for what we know today, that the deal will be rejected.
What else are you watching today? What else is interesting you in the markets and in the global economy?
Well, I think, like I said, the markets have been really, really wild over the last month, and I do think that this is an opportunity to start picking away, because I do think the AI story is not over at all, and I do think for those people that kind of missed it on the way up, this is an opportunity to nibble away. I would certainly not advocate putting every nickel you have, but I would be starting to pick away at this basket of stocks, because it's my kind of overall view that the economy is slowing, that we'll either go to either some sort of no growth or some sort of very mild recession. And in that kind of environment, the secular growth winners are going to be the stocks that outperform over the next couple of years.
Please tell us a little bit about Wayve Capital Management, what you do there, where we can follow you.
So Wayve Capital is recently we started about less than a year ago now. Really, this past year we just got the portfolio company. We have 3 different products, but I think you should just go to our website and you can see what's available. I'm not sure exactly what I can talk about on television, what I can't. So I'll just leave it at that we're very excited. It's a interesting firm because it's a diverse firm. It's majority African-American owned, and it's 3 Duke guys. I'm the oldest of the Duke guys, but there's 2 30-something people as well that are the founders of the firm. And, we're excited both to grow institutionally and also in high net worth.
Thank you so much for joining us. A wonderful conversation.
Thanks for having me.
And thank you for tuning in today to The Money Path. I'm Janet Alvarez. It's always a pleasure to have you join us. We'll be right back here in a couple of days with more of the news that's moving markets and the brightest minds behind them. Until we meet again, see you soon.